Welcome to Wealth and Means. Advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode is stacked. What you didn't see in the news on the trends quietly tilting culture and markets. Wake up ready so you don't get blindsided by this week's data. A knowledge bomb on how investors get sidetracked. A bank fee reality check in Humor Me. A big picture clash in the greater debate. And we'll land it with a Let's Invent Again story about leftover turkey and a laser that changed medicine.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. All right, this is the part of the show where we talk about the stories that didn't win the headline lottery last week, but are quietly lining up the dominoes for what everyone's going to be yelling about a month from now. Let's start where culture always starts now, the scroll. There's a new format bubbling up on TikTok built around a familiar Nicki Minaj audio clip, the What's Going On trend. And here's why it matters. It's not played out yet. Creator adoption is still climbing, not flattening, which means we're in that brief golden window where something can still feel organic before marketing teams industrialize it. That's the stage when politicians sneak messaging in sideways, when brands quietly test tone shifts, and when internet culture decides what's cool before it decides what's annoying.
So this is the moment before your parents discover it.
Exactly. Once that happens, it's over. Closely tied to that is another shift in how people are telling stories right now. You're seeing these "I'm bored, tell me about" videos everywhere, basically inviting the audience to create the content with the creator. And then you've got the subtle foreshadowing clips, where the creator promises you a reveal later instead of dumping the whole story at once. That's not just a format change, that's attention training. People aren't just consuming stories anymore, they're helping write them. And that changes how brands tease launches, how scandals unfold, and how influencers stretch one moment into a 4-day event instead of a 4-hour one. Now the mood whiplash. Search traffic for AI-generated deepfake confessions is exploding. These are fake celebrity videos where someone is apparently admitting to a crime, a scandal, or a political stance, complete with realistic voice and facial expression. Most of them get debunked, eventually. But the damage usually happens before the correction. The scary part isn't that these exist. It's that we're entering the era where lies move faster than verification. And once that dynamic starts nudging elections, stocks, or public unrest, you can almost hear the regulatory gears starting to turn.
The next viral apology might not even be real.
And it might still wipe 10% off a stock before anyone figures that out. On the lighter side of the internet, there's a meme ripping right now that's both dumb and dangerous in the best way. The sorry for being too good trend. It's brands mock apologizing for how good their product is, and it's spreading because it perfectly skewers corporate apology language and consumer skepticism at the same time. If a mass brand like Starbucks jumps into this during the holiday season, you'll see it everywhere in about 5 seconds. But the second it gets overproduced, the internet will hunt it for sport. Then there's this audio trend flying a little under Western radar, the Telugu dosa remix wave. Food, rhythm, comedy, dance, all stacked into one endlessly remixable format. Duets are exploding. This is how global genres are born now. Latin pop did it. K-pop did it. If this collides with Western pop choreography, it goes from niche internet thing to real economic force. Tourism, food brands, sponsorships, all of it. Zooming out to sports for a moment, India just won its first Women's Cricket World Cup. The emotional recaps went wild. Youth participation searches jumped. Sponsorship interest jumped. That's not just a feel-good moment. That's a structural reset. This is the kind of win that changes broadcast deals, funding pipelines, and who gets pushed as the next generation of stars for the next decade.
That's how women's sports turns from a cause into a business.
Exactly. Now, for identity on the internet, which is getting weird in a very specific way. Absurdist AI avatars are surging, melting faces, surreal bodies, hybrid creatures that look like they escaped someone's subconscious. People aren't trying to look real anymore. They're trying to look interesting. If that plugs into gaming economies or virtual storefronts, your avatar stops being a profile picture and starts being an asset, something you brand, trade, license, and monetize. All right, let's talk money that moved without screaming. Comfort Systems and MCore both jumped last week, and not because of shiny AI software announcements. They moved because of boring words like cooling, power routing, and mechanical systems for data centers. This is the under-the-hood layer of the AI boom. Chips get the headlines, electricity and heat get the invoices, and those invoices are getting very large. IonQ caught momentum after a quantum fidelity milestone and a big cash raise. Translation: the market isn't buying near-term profits. It's buying survival. You don't need quantum revenue today. You just need to still be standing when it finally matters. Universal Health Services moved on earnings and guidance tied to behavioral health. Mental health usage isn't a pandemic blip anymore. It's a long-term demand curve. That turns hospital operators into something closer to defensive growth stocks. Insulet popped on confidence in automated insulin delivery. Diabetes tech is quietly shifting from sell hardware once to something that behaves a lot more like a subscription business. Closed-loop systems mean recurring economics.
So even your pancreas is headed toward monthly billing.
Unfortunately, yes. Down in OTC land, the deep end of the risk pool, things got spicy. CSI Mantra moved on reports of over 100 new robotic surgery installs. If regulatory approvals come through, that's surgical robotics breaking out of premium Western hospitals and into price-sensitive global markets. MRMD Bio jumped on cannabis speculation. That one isn't about earnings, it's about Washington. These rallies live and die by one policy headline. QPerfect picked up funding tied to post-quantum cybersecurity. It's a tiny niche now, but when encryption migration becomes mandatory instead of theoretical, everyone will suddenly care at once. And LendingCart moved after settling a legal battle that restored founder control of a majority stake. That's not a revenue story, that's a clarity story. Markets hate fuzzy ownership more than bad numbers. So that's the layer beneath the headline layer, the stuff quietly tilting the board before the rest of the world notices it's already leaning.
Which is exactly why most people miss it.
And why we talk about it. All right, this is one of those weeks, the kind where a single number at 8:30 in the morning can move rates, stocks, oil, and your group chat all before lunch. Let's walk it day by day so you don't just wake up informed, you wake up ready. Monday, December 1st. We start the week with factories, construction, and oil rigs setting the tone. At 10 a.m., the U.S. ISM manufacturing PMI hits. This is the fastest snapshot of how America's factories are feeling right now. The clean question the market is asking: are factories healing or stalling again? If it prints weaker than expected, rate cut chatter heats up and cyclicals feel pressure. If it surprises higher, yields can jump and soft landing confidence gets louder. At that same hour, construction spending drops. Basically, who is still pouring real concrete in the real world? Housing, infrastructure, materials, heavy machinery, all of that trades off this. Just before that, Canada's manufacturing PMI gives a quick read on cross-border energy and tech supply chains. Not flashy, but it matters. Pre-market, Tesla drops a Q4 delivery update, and this is no longer about hype, it's about demand. The real question: are EV sales still expanding or just normalizing under higher rates and tariffs? A beat lifts the whole EV complex. A miss feeds the hybrids are winning narrative. Then at 1 p.m., the Baker Hughes U.S. rig count hits. This is future oil supply in slow motion. Fewer rigs today usually means tighter supply and firmer prices tomorrow.
So Monday tells us if factories are alive, builders are building, and drillers are still drilling.
Exactly. The physical economy report card. Tuesday, December 2nd. Tuesday is all about orders, energy, and enterprise tech flexing. At 10 a.m., U.S. factory orders print. This answers one blunt question: are companies still buying big, expensive stuff or quietly pulling back? Aircraft, servers, heavy equipment, all flow through this. At 10:30 a.m., the EIA natural gas storage report lands. In winter, this moves prices fast. The only thing traders care about, are we burning through storage faster than expected? Big draws spike prices. Surprise builds knock them down. Midday, OPEC Plus releases its monthly oil market report. This is where they politely tell the world whether they're leaning toward tighter supply or fighting for market share. Any hint of tighter quotas and oil catches a bid immediately. All day long, JP Morgan Chase hosts its Investor Day. This is a window into credit quality, consumer strength, and how aggressively big banks are deploying tech. The quiet question underneath all of it, are banks getting ready to press the gas after rate cuts, or still driving with one foot on the brake? And at 1 p.m., Oracle rolls out new cloud and AI products. This is Oracle's audition for the big leagues of enterprise AI. If customers bite, it's a real revenue story. If not, the market smells vapor fast.
So Tuesday is, are businesses ordering, is energy tightening, and can Oracle actually crash the AI party?
That's the whole board. Wednesday, December 3rd. This is where macro and oil volatility collide. At 8:15 a.m., ADP private payrolls drop, your early sketch of Friday's jobs report. The one clean question, is the labor market easing gently or cracking fast? Strong jobs push yields higher and pressure long-duration tech. Softer jobs revive the rate cut trade. At 10:30 a.m., crude oil inventories hit. This shows whether barrels are quietly disappearing from storage or piling up. Surprise draws lift oil and energy stocks almost instantly. Early in the morning overseas, Eurozone services PMI prints, shaping global risk sentiment. If Europe looks weak, U.S. multinationals feel it. Then at 2 p.m., the Federal Open Market Committee minutes drop from November. This is where the real story lives, how divided policymakers are on inflation and cuts. The question markets will fight over for hours. Are we closer to cuts are coming or stuck in higher for longer? Wrapped inside that day is an ExxonMobil guidance call giving insight into how one of the biggest energy players sees global demand.
So Wednesday is jobs vibes, oil vibes, and Fed subtext.
You guessed it, and all three can move markets in different directions at the same time. Thursday, December 4th. Thursday morning hits fast. At 8:30 a.m., we get jobless claims, the U.S. trade balance, and productivity with labor costs. Three signals at once. Claims ask, are layoffs creeping higher? Trade balance asks, is energy still bailing out U.S. exports? Productivity and labor costs answer, are wages still threatening inflation? At 7 a.m., before all of that, Bank of America reports earnings. This is a live check on the American consumer and corporate borrower. Strong credit keeps the soft landing story alive. Rising delinquencies spook the whole financial complex. Late morning, Chevron hosts its investor meeting on LNG, oil strategy, and tariffs. The deeper question, are energy giants positioning for structurally higher demand or bracing for policy and EV headwinds? Overnight into Thursday, China's Caixin Services PMI prints. This tells you whether global demand is quietly stabilizing or still sliding.
So Thursday is workers, trade, banks, and barrels before most people finish breakfast.
That's why traders don't sleep in. Friday, December 5th. Everything funnels into Friday. At 8:30 a.m., we get non-farm payrolls and the unemployment rate. This is the main character of the week. Payrolls answer, how many jobs did we really add? Unemployment and wage growth answer, is inflation pressure easing or about to reignite? Hot jobs plus hot wages keep rates elevated and pressure risk assets. Cooler jobs with softer wages light up the rate cut trade and push stocks higher. At 10:30 a.m., the EIA Petroleum Status Report lands, gasoline and distillates heading into the holiday season. Then at 1 p.m., the global rig count wraps the entire drilling picture for the week. After the close, NVIDIA updates on AI chip demand. This is where the entire AI trade listens for one thing only. Is growth still compounding or finally digesting? If guidance is monstrous, momentum rips. If there's even a whisper of slowdown, multiples across AI names get rewritten.
So Friday is jobs move rates, oil feeds inflation, and NVIDIA moves. Everything else.
That's the scoreboard. Weekend. No scheduled data, but plenty of unscheduled risk. Any geopolitical shock, energy disruption, or surprise election headline can gap markets before Monday's open. So here's your map: factories and rigs on Monday, orders in oil on Tuesday, jobs and Fed signals on Wednesday, wages and banks on Thursday, and the full macro climax plus NVIDIA on Friday. Follow that rhythm, and you're never reacting late. You wake up ready.
All right, here's today's knowledge bomb, and this one might save you more money than anything you hear all year. Your first paycheck hits, and suddenly everyone around you sounds like a hedge fund podcast, zero DTE, leverage, private equity. It all sounds impressive. It all sounds fast. And most of it is designed to separate beginners from their money. So here's the only rule you actually need. If you can't clearly identify where an investment's cash flow comes from, don't touch it. That's it. That rule alone can protect you from 90% of financial disasters. Every investment, no matter how sophisticated it sounds, is the same basic trade. You give up cash today for expected cash later. What changes is how predictable that future cash is, how long you wait, and how much risk and fees sneak in along the way. Modern finance is very good at hiding that simplicity, and complexity usually serves two purposes. It hides risk, and it justifies high fees. We saw exactly what happens when nobody can follow the cash during the 2008 crisis, dramatized in The Big Short. When even professionals lose track of where the money is really coming from, the system doesn't wobble. It snaps. Now let's talk about the stuff you hear the most online. Futures, DTE options. All of that lives in the world of derivatives and leverage. These are not long-term investments. They're trading tools. Futures let you control a big position with a small amount of money, so tiny price moves create massive gains or massive losses. DTE options take that to the extreme. They expire the same day you buy them. The only guaranteed cash flow is the premium you pay, and that melts toward zero by the hour if the price doesn't move immediately. You're not buying an asset. You're buying a countdown clock. These tools can help professionals hedge risk. For beginners, they act like casino games with better lighting. Then there's the velvet rope world: hedge funds, private equity, private debt. What ties these together isn't sophistication, it's this: your money disappears for years. Hedge funds trade aggressively and collect heavy fees, often 2 and 20. You pay to get in, and you pay again if they win. Private equity buys companies and sells them years later. No steady cash flow, just one big payout if things go right. Private debt makes high-interest loans to companies outside the banking system. The income can be strong, but the risk is concentrated. These structures are built for institutions that can lock up money for a decade without blinking. They are not built for first-job investors. Now here's the part nobody glamorizes because it's boring. For most people, the best long-term wealth-building tool is still the S&P 500 index fund. Investors like Warren Buffett and Charlie Munger have repeated this for decades because it actually works. You automatically own small pieces of 500 major U.S. companies. You benefit from the growth of the entire economy. Fees are tiny. There's no constant guessing. No hot hand chasing. It is boring on purpose, and boring compounded for 40 years is unstoppable. So here's the golden rule in action. Before you invest a single dollar, ask, where does the money that pays me actually come from? Stocks, business profits and dividends. Bonds, interest from borrowers. Private equity, a future business sale. Private debt, loan interest. Zero DTE options. The only reliable cash flow is the premium you lose. And here's the line to remember. If the only guaranteed cash flow is the fee you pay, you're not the investor, you're the product. If you can't explain the cash flow in one clean sentence, you don't understand the investment yet. Wealth is not built through secret strategies, insider jargon, or financial gymnastics. It's built by investing consistently, keeping fees low, understanding exactly how your money works for you, and letting time, not leverage, do the heavy lifting. If a product replaces transparent cash flow with speed, fog, and complexity, it isn't an investment. It's a wager that primarily enriches the fee collectors. So remember the rule. Follow the cash, fear the fog. That's the knowledge bomb.
Humor me for a second, because this one feels way too real. A guy walks into his bank and says, "I'd like to open a simple checking account." The banker goes, "Perfect, we have a free checking account." And the guy says, "Free? Say less." The banker says, "Well, the checking is free. There's just a $12 monthly maintenance fee." So the guy goes, "So it's not free?" And the banker says, without blinking, "No, the checking is free. The fee is for maintaining the account that lets you check for free." The guy pauses. "Okay, what if I keep a minimum balance?" Banker says, "Then we waive the $12." Guy says, "Great. What's the minimum?" Banker says, $25,000. And the guy goes, "So to avoid paying you $12 a month, I have to give the bank a free $25,000 loan forever?" Banker smiles like a Disney villain. "Exactly, or you can just pay the $12. See? Options." Guy says, "What if I dip below $25,000 for one day?" Banker says, "That's a $35 balance protection fee." The guy stares. "Is there an account that's actually free?" Banker lights up. "Absolutely. Our totally free checking, no fees at all." Guy says, "Really?" Banker says, "Yep. It comes with our premium debit card." Guy says, "And?" Banker says, "That's $10 a month." Long pause. Guy stares directly into the void. Banker slides a pen across the counter. "Would you like a free pen?"
Here's a free tip. Welcome back to the greater debate, the conversation that should happen far more often and almost never does, usually because it ends in raised voices and cold coffee. We stage it anyway, powered by caffeine, curiosity, and the stubborn belief that adults can disagree about economic ideology without body slamming each other through the furniture. Tonight's greater debate isn't about a stock, a bubble, or a crash. It's about the soul of investing itself, and it pits two men who don't just disagree, they represent two different centuries of finance. In one corner, the patron saint of patience, the architect of low-fee long-term ownership, Jack Bogle, quiet voice, ruthless math, believer in boring. In the other corner, the insurgent of fintech, the apostle of access, the man who put Wall Street in your pocket, Vlad Tenev. Fast interface, loud culture, believer in participation. And the question is brutal in its simplicity. Is investing supposed to be disciplined ownership or radical participation? Bogle steps forward first, and he doesn't raise his voice. He never had to. He says investing is simple. You own productive businesses. You pay as little as possible. You hold for as long as possible. Everything else, options, leverage, day trading, constant motion, is just friction and fees eating your future. Then he lands the first knockout. Bogle says, before costs, active investors as a group match the market. After costs, they must underperform. Not opinion, not philosophy, arithmetic. He looks straight at modern trading culture and says, the more you trade, the poorer you become. He calls speculation a zero-sum game that turns negative once tolls are collected. And then he draws blood. He says platforms built on constant activity don't serve investors. They harvest them. You can feel the room hold its breath. And then Tenev answers. Not defensive, not apologetic, sharp. He says Bogle built a beautiful system for people who were already allowed inside it. He says before mobile trading, before zero commissions, before fractional shares, most Americans weren't investors at all. They were spectators, locked out by minimums, jargon, and an industry that talked down to them. And Tenev lands his own punch. He says access isn't a luxury, it's the starting line. And he implies that a philosophy that protects people by excluding them is just another form of elitism. The crowd shifts. Now Bogle fires back with something colder and deadlier. He says access without discipline isn't freedom, it's exposure. He says friction wasn't always a villain. It slowed people down long enough to stop irreversible mistakes. And then he stares straight into the camera and says the line that rattles the room. Turning investing into entertainment doesn't democratize wealth, it monetizes impulse. That's a body blow. He points at zero-day options at crypto volatility, at leverage on demand, and he says this isn't ownership, it's velocity, and velocity doesn't compound, it burns. And for a moment it looks like Bogle has won. Then Tenev pivots and goes for the head. He says indexing did democratize ownership, but centralize control. He points to Vanguard and its peers and says, a handful of giants now vote the shares of corporate America. Millions of people own companies but wield no meaningful say. And then he drops the line that lands like a cracked rib. Indexing decentralized risk, but it re-centralized power. Now nobody is blinking. Tenev goes further. He says the greatest wealth creation of the last 30 years happened before the IPO. Space, AI, data, platforms. And who captured that upside? Venture capital, institutions, the already wealthy. He says if retail investors only get access after the growth curve bends, that isn't investing. It's arriving after the party and paying full price for the empty bottles. Now it's Bogle who looks momentarily cornered. And then he delivers the quietest knockout of the night. He says private markets aren't dangerous because they're exclusive. They're dangerous because they're opaque, illiquid, and fee-heavy. He says opening those doors to everyday investors doesn't democratize upside. It democratizes blow-ups that professionals barely survive. And then he delivers the dagger disguised as a whisper. The greatest risk is not missing the next unicorn. The greatest risk is losing your compounding. Silent. Tenev answers with something Bogle can't fully disarm. He says people don't just invest for retirement anymore. They invest for identity, for belief, for participation, for culture. He says a generation raised on real-time data doesn't want to set it and forget it. They want to engage, to express conviction, to be part of the market's conversation, not just its pension plan. And then he throws the punch that lands emotionally, even if not mathematically. Ownership without engagement feels like invisibility. Now both men have landed. Bogle closes by lifting the simplest weapon in finance, the humble index fund. He invokes the S&P 500 index fund and calls it the cleanest contract ever written between capitalism and the citizen. Minimal cost, maximal participation, no guessing, no games, just ownership. He says the market already rotates winners and losers for you. All you have to do is not interfere. Tenev closes by redefining the word investor. He says an investor isn't just someone who waits, it's someone who participates, who experiments, who learns in motion, who takes risk early, not just protects wealth late. And then the final truth settles over the room like static. Bogle taught people how to build wealth. Tenev taught people how to enter the arena. One optimized for outcomes. One optimized for access. One believes the greatest enemy of returns is the investor himself. The other believes the greatest enemy is the system that kept the investor out. And that's the anxiety in the room tonight, because both men are right about different truths. And both men are wrong about the danger they underestimate. Bogle underestimated how badly people want to participate. Tenev underestimates how brutally participation can punish the unprepared. Ownership versus action. Discipline versus expression. Stewardship versus speed. This debate doesn't end tonight. It ends in your brokerage account 20 years from now, when we find out whether access built wealth or just built motion. That's the greater debate.
Now, let me tell you a story that starts with leftover Thanksgiving turkey and ends with more than 40 million people seeing the world clearly without glasses. This is the kind of accidental breakthrough Silicon Valley fantasizes about, but almost never actually gets. Our inventor today is James J. Wynn, Brooklyn kid, Harvard-trained physicist. Then he does what a lot of elite scientists of his era did. He vanished into the research engine at IBM, working for decades at the Thomas J. Watson Research Center. Lasers, physics, blue sky thinking that doesn't always show up on earnings calls. Then, Thanksgiving weekend, 1981. Wynn's colleague, Rangaswamy Srinivasan, is in the lab experimenting with an ultraviolet excimer laser, the kind of thing normally used to etch microchips. Someone had brought in leftover turkey. Srinivasan points the laser at a piece of cartilage, and instead of burning it, the tissue disappears. No charring, no heat damage, no collateral mess. Gone. That moment is now considered one of the most valuable oops moments in modern medicine. Until then, medical lasers worked by heat. They cooked tissue. That's fine if you're cauterizing. It's catastrophic if you're trying to sculpt the human eye. But this laser behaved differently. It fired deep ultraviolet pulses so fast, nanoseconds, that heat never had time to spread. Instead of burning tissue, it broke molecular bonds directly. The technical term is photoablation. The plain English version? It erased living tissue with microscopic precision, without cooking anything around it. And this is where Wynne enters the story in a big way. He became the physicist who proved this wasn't just cool, it was safe. He measured exactly how much tissue removed per laser pulse. He showed it didn't create cancer-causing byproducts. He turned a freak lab accident into something regulators, surgeons, and manufacturers could trust. That work became the core physics behind refractive laser eye surgery. Fast forward a few years, first PRK, then the procedure everyone actually knows by name, LASIK, a thin flap, a few seconds of ultraviolet sculpting, a cornea reshaped at fractions of a micron, and suddenly, glasses and contacts were no longer a lifetime sentence. Today, about 1 million people a year in the US still get laser vision correction. Globally, it's tens of millions. An entire industry worth billions annually exists because one category of laser didn't behave the way every other one before it had. But here's the part most people miss. The real breakthrough wasn't eye surgery. The breakthrough was proving that light could remove matter by chemistry, not heat. That single idea quietly unlocked new medical frontiers: dermatology, cardiology, oncology, vascular surgery, tattoo removal, psoriasis treatment, precision skin lesions, even laser angioplasty. All of it traces back to the same physics Wynne helped validate in the 1980s. Years later, Wynne and his collaborators were inducted into the National Inventors Hall of Fame. They received the National Medal of Technology and Innovation and the Fritz J. and Dolores H. Russ Prize, often called the Nobel Prize of Bioengineering. But here's my favorite detail. Wynne never really cashed out. Even into his 80s, he's still in the lab, working on newer ultraviolet lasers that eliminate toxic fluorine gas from older Excimer systems. Same mission, cleaner tools, broader applications. And for more than 30 years, he's also been running hands-on laser science programs for high school students and teachers, opening the black box so the next generation doesn't just use technology, but understands it well enough to bend it. So yes, practically speaking, Wynne helped give clear vision to tens of millions of people. But strategically, he helped prove something even bigger, that surgery doesn't have to be violent. That light, properly engineered, can be a scalpel. And in an era racing toward gene editing, nanosurgery, and targeted cancer therapies, that shift in thinking may end up being just as important as the eye chart. That's today's reminder. Innovation doesn't always arrive with a keynote. Sometimes it shows up on a holiday weekend. Next to leftover turkey, in a lab nobody outside of physics was watching. Let's invent. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the range. From TikTok trends to deepfake danger, fee traps at your local bank, to billion-dollar battles over how we invest, and all the way to lasers born from leftover turkey.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious.
Stay kind.
And keep compounding